Hello, and welcome to this lecture video. In this lecture video, we're going to be talking about held to maturity securities and also available for sale securities. So held to maturity securities, these are only debt securities because stocks don't have a maturity. You can hold a stock for 20, 30 years. Okay? There is no maturity date on a stock, but there is on a bond. So when we're talking about held to maturity securities, we're only talking about buying bonds or debt of another company. And that debt has a maturity date. That's why we can call them held to maturity securities. As we were talking about in some other lecture videos, where are they reported? They're going to be reported as current assets if their maturity dates are within 1 year. But if it's longer than a year, then we're talking about non-current assets. Okay? Let's talk about available for sale securities. And so unlike trading securities, where we're actively trading the securities with our trading securities, and we're trying to make some short-term profits, which would be the difference between the market value or the fair value and then our costs. And that's how we would make money with our trading securities. In terms of available for sale, they're debt and equity securities that are not classified as trading or held to maturity. They are also purchased for a different intent than trading securities. Trading securities, remember, are purchased in order to make some short-term gains, which would be the difference between what the fair value is, which is the market value, against the cost. Okay? So almost the whole idea of buy low, sell high. Available for sale securities, on the other hand, are purchased for dividends and also interest payments, interest revenue and dividend revenue. They're not actively managed like trading securities would be. In terms of how we report these, if the intent is to sell the securities in 1 year, they would be reported as short-term, long-term. If the securities don't meet those short-term investment requirements, so it's longer than a year, and then of course that cascades up here to current assets for short term, and then non-current for longer term. Okay? In terms of valuing and reporting, they're reported at fair value similar to our trading securities, and the companies can adjust the cost of the entire portfolio of those available for sale securities, just like what we did with trading securities. And just like with trading securities, we can have some unrealized gains, unrealized losses on the entire portfolio. So that's also important. Let me just emphasize that, the entire portfolio. So you're not looking at individual stocks or individual bonds. You're looking at the entire portfolio. So if you had 10 stocks and collectively they all increased by $1,000, some went down, some went up, but when you took the average, it was $1,000 increase over cost. That's the entire portfolio. So that's where you would have the unrealized gain of $1,000. So you're not looking at individual, you're looking at the entire portfolio. Okay? The unrealized gains or loss, unlike trading securities, where the unrealized gains and losses were reported on the income statement, in this case, they're reported on the equity section of the balance sheet. Okay? And so I'll show you a picture of that. So if we look at this example, let's assume that Music City had no prior investments. In the current period, Music City acquired 2 available for sale securities. On December 31st, the following information is provided. We would have to do, just like what we did with trading securities, a year-end adjustment for fair value. Okay? For fair value. So you look over here, here's our cost, and then here's our market value. So it increased by $1,550. And you can see we're not doing this individually by stock, right? We're doing it at the portfolio level, so all stocks combined. One stock went down, one stock went up, combined, they increased by this much, $1,550. So this is what we use to do our fair value adjustment. Okay? So similar to what we did with our trading securities, we would debit our fair value adjustment. And I'll say available for sale. Okay. And then I have my unrealized gain. And I'll say equity to say that it's going to be showing up on the equity section of the balance sheet. Okay. 1,550. Right? If this cost, if this market value, for example, this fair value, the market value, was 70,000. Okay? If this were 70,000, not 74, then you can see we're $3,000 under cost. Let's look at that journal entry. So we'll say assume FV fair value. I'm just going to write FV fair value at $70,000. What would be our journal entry? Well, in this case, we would debit our unrealized loss equity for $3,000. And why $3,000? Because the cost is 73, the fair value is 70, the $3,000 difference. And then what would I'll also have my fair value credit to my fair value adjustment. AFS, available for sale. I'll just write AFS for $3,000 right there. Okay? So if we assume the fair value is 70,000, then we basically have a loss of 3,000, and it's unrealized because we haven't sold it yet. So we debit our unrealized loss equity for 3,000, and then unlike over here where we had a gain, where we debited the fair value, because it's decreased, we would credit the fair value adjustment, AFS, for $3,000. Okay? And this is how it looks on the balance sheet. So in this case, we're returning back to the situation where the fair value was $74,550. And so what we have is, here's our cost. We show it at cost, what we bought these for at cost. And then we show the fair value adjustments. And then we report them at fair value. And then here's our unrealized gain on available for sale on AFS Securities, which is this, $1,550. That's right over here. It's in the equity section of the balance sheet. Okay? So when we talk about selling our available for sale securities, it's very similar to what we talked about with trading securities. We compare the cost of our individual securities against the cash proceeds. Okay? And then we recognize either a gain or loss, similar to what we did with trading securities. Okay, so here's what I want you to do. I want you to stop the lecture video and do these quick check problems on page 322, and then we'll check them together. Hello and welcome back. So let's see how you did. So over here, the first one, investments in debt and equity securities that the company actively manages and trades for a profit are referred to as short-term investments in trading securities. Okay, and the key here is actively manages and trades for profit. That's telling you it's the trading securities. Available for sale securities are recorded at cost. They can earn dividends because it says equity securities right over here. So we would earn dividends on equity securities. They can be classified as short-term or long-term, and they are reported at market value, fair value on the balance sheet, all of these. This last one, 6 months ago, a company purchased an investment in stock for $65,000. The investment is classified as available for sale securities. The current value is $68,300, so it increased by $3,500. So our journal entry, we look over here. This would be our full journal entry. Debit to our fair value adjustments, AFS, available for sale, $3,500. Credit our unrealized gain equity for $3,500. This is the full journal entry, so you can see the correct answer is B. Okay. Thank you so much. In the next series of lecture video, in the last lecture video for Chapter 15, I'll be talking about reporting influential investments and also talking about investments in securities with controlling influence. Thank you.